Hello and welcome to my channel. This video is part of NISM Mutual Fund Distributors playlist. To all those who are new to my channel, I have already uploaded a playlist on this NISM Mutual Fund exam where I have covered all the chapter videos thoroughly along with a mock test video. Now this is going to be mock test part 2 where many more practice questions are provided which will enhance your knowledge testing and will give you a practical exposure to the exam. So I hope this video is going to be helpful, and as I already have mentioned in my previous videos also, I will again mention this, that once you cover all the chapter videos, then only you go through these mock test videos, because that's the good approach towards learning. Your practical examination will require a lot of concept understanding. If you understand the concepts, if you have a good knowledge about this particular subject, the questions will seem to be very easier for you. So first go through all the chapter videos and then you try to attempt these mock test videos. One has already been uploaded, and here's the another mock test with many more questions. The first set was with 100 questions and this one comes with 60 more practice questions. Now I will put the link to the playlist in the description box as well as on the I button, so that you can go through and watch the full playlist. Now let's start with this one. Question 1. Long duration debt scheme invests in debt instruments with Macaulay duration. Option A, between 1 year and 3 years. Option B, below 1 year. Option C, greater than 7 years. Option D, 6 months and 12 months. So choose the correct option. And the right option is option C, greater than 7 years. So you must observe in this question, it is talking about long duration debt schemes. We know that any particular fund or mutual fund or scheme which is investing in long duration instrument must be more than 3 years. So other three options where it is 1 year and 3 year, below 1 year, 6 months and 12 months are already invalid for this question. Now comes where the exactly question is targeting towards. So long duration debt scheme, it is as per SEBI mandate that these particular scheme must invest in debt instrument which is having Macaulay duration greater than 7 years. So not less than 7 years will be valid. 4, 5, even if it is more than 3 years, it won't be valid. It should be greater than 7 years. Now, what exactly is Macaulay duration? So Macaulay duration, when we talk about bond or debt instruments, we know that there is a property in which properties of these bonds where they provide a regular cash flow, and after a certain period of time there is principal repayment. So all the cash flows, Macaulay duration tries to calculate the weighted average time which is taken by an investor to receive all the cash flows from a bond. That is what Macaulay duration is. Now let's move to our second question. For which of these documents is time stamping mandatory? Option A, payment instrument only. Option B, application form only. Option C, transaction slip for buying additional units. Option D, both for application form, transaction slip and payment instruments. So choose the correct option. And the correct option is option D, both for application form, transaction slip and payment instrument. Now you must know that time stamping, what exactly time stamping mean? That whenever a particular event is happening, the date and time of that event should be mentioned. Now time stamping is mandatory for all financial transaction in mutual funds. Whether we talk about buying new units of mutual fund or redeeming money, there should be time stamping. Question 3. The loss booked from a debt investment of 15 months can be set off against. Option A, long-term capital loss. Option B, short-term capital loss. Option C, short-term capital gain or long-term capital gain. Option D, it cannot be set off. Take your time and pick the right option. And the right option is option C, short-term capital gain or long-term capital gain. Now see, whenever we talk about here we must see that it is the question is mentioning the loss booked from a debt investment of 15 months. When it says 15 months, you can quickly get into your mind that it is talking about a short-term instrument. So whenever we talk about a scheme or fund which is for more than 3 years, we will consider that as a long term. If it is less than 3 years, we will consider it as short term. Now, when we talk about short-term capital loss, how can it be set off? So, your short-term capital loss can be set off against short-term capital gain or long-term capital gain. Now, when we talk about long-term loss, if you have incurred a long-term loss, that can only be set off by long-term gain. But if you have incurred short-term loss, it can be set off against whether the short-term gain or long-term gain both. Okay, you must keep this in mind that long-term capital loss can be set off against long-term capital gain only. When we talk about short-term capital loss, it can be set off against both the short-term capital gain as well as the long-term capital gain. Let's move to question 4. Identify the true statements. Statement A. Mutual fund scheme with a beta of less than 1 is less risky than market. Statement B. The diversified stock index has a beta of 1. Statement C. Unsystematic risk is measured by its beta. And here are your options. Option A. Only A is true. Option B. B and C. Both the statements are true. Option C. A and B are true. Option D. All A, B and C statements are true. Choose the correct option. And the right option is option C. A and B statements are true. Now let's again read this. It is asking about which statements are true. So statement A was mutual fund scheme with a beta of less than 1 is less risky than market. So obviously this is totally correct, and I have covered this when I was talking about beta in my concept videos, where beta represents the market risk. So if beta is 1, it is equal to the market risk. If beta is less than 1, it is less riskier, the asset is less riskier than market. And if it is more than 1, it means that the asset is more riskier as compared to the market. So the first statement, that less than 1 beta is representing less risky asset than the market, is totally correct. And then second statement, the diversified stock index has a beta of 1. So as I already mentioned, beta of market is 1, and here diversified stock index is representing a market index like Sensex or Nifty, and thus the beta of these index will be 1, which is equal to the market risk. And then there is this statement C, which says unsystematic risk is measured by its beta. No, this is totally wrong statement, because we know that systematic risk is measured by beta. What is systematic risk? It is market risk. What is unsystematic risk? It is pertaining to a specific asset. So specific risk. But when we talk about beta, it is for measuring the market risk and thus the systematic risk, not the unsystematic one. Let's move to question 5. In which of these options can an investor expect a cash flow in his bank account? Option A, bonus. Option B, dividend payout. Option C, dividend reinvestment. And option D, growth. Choose the correct option. And the correct option is option B, dividend payout. Okay. So here the question is asking that in which of these options the investor can expect a cash flow in his bank account. So will it be in bonus, Obviously not, because we know that what happens in bonus, new units are allotted. So if you are having right now 1,000 units of mutual fund, you will be allotted extra additional units when bonus is declared. So new units are allotted. It is not like money is coming to your bank account. When we talk about dividend reinvestment, we know that whatever dividend is declared as per that fund, that is not received in bank account, that is reinvested in the scheme, and that's how this has got its name also, dividend reinvestment. When we talk about growth option, we know that in this nothing, once you redeem your money, then only you get it in your bank account, and there is nothing like you can expect a cash flow either in form of dividend or anything. You can't expect that, because it is a growth scheme where capital appreciation is in focus. So no cash flow is generated until you redeem the money and get it in your bank account. So the correct option is dividend payout. What happens in dividend payout? Whenever dividend is declared, you are paid that dividend directly in your bank account. Let's move to question 6. For how long is the trail commission paid to the mutual fund distributor? Option A, for the first 1 year only. Option B, for the first 3 years only. Option C, for the first 10 years only. Option D, till the money is held in the fund. So choose the correct option. So the correct option is till the money is held in the fund. Now mutual fund distributors, they are paid this trail commission for as long as investors' money is there in the fund. Now this trail commission varies somewhere between 0.25 to 1% of your invested amount, and it is paid to the distributors every year. When it comes to equity instruments, it is paid quarterly basis as well. So in this question, for how long? It is till the money is there invested in a particular fund by the investor. Question 7. What is negative alpha? Option A, it is indicative of outperformance by the fund manager. Option B, it is indicative of underperformance by the fund manager. Option C, it is indicative of over-hedging by the fund manager. Option D, it is indicative of under-hedging by the fund manager. So choose the correct option. And the correct option is it is indicative of underperformance by the fund manager. So what exactly alpha represents? It shows you the difference between the scheme actual return and its optimal return. In simple words, you can also understand it in a way that it is a measure of fund manager's performance. So always there is a benchmark and a scheme's optimal return which is targeted for the performance of a particular scheme. Now, if the fund manager is not able to provide the optimal return, is not able to cross the benchmark of the fund, that is declared as underperformance by the fund manager, which is also called as negative alpha. In the same way, when we call positive alpha, that means that a particular fund manager has given an outperformance in that particular scheme. It has crossed its benchmark and the optimal performance. So underperformance, negative alpha, positive alpha will be outperformance. Question 8. As per SEBI regulations, a mutual fund scheme should have at least dash investors. Option A 10, option B 15, option C 20, option D 25. So choose the correct option. And the right answer is option C 20. You must understand this. As per SEBI, a mutual fund scheme shall have minimum of 20 investors. Along with that, no single investor shall account for more than 25% of the corpus of the scheme. Okay, so there should be at least 20 investors, and any particular investor cannot hold more than 25% of the total corpus of that scheme. Coming Question 9. Business model, experience and proficiency in business is a compulsory criteria for empanelment and review of which of the following category of mutual fund distributors? Option A. Individual distributors who have points of presence in more than 10 locations. Option B. Distributors who have received commission of over rupees 1 crore per annum across industry. Option C. Both the options are correct. Choose the correct option. So the correct option is distributors who have received commission of over rupees 1 crore per annum across industry. Now SEBI has mandated all the AMCs to put a proper due diligence for all those distributors in terms of business model, experience or proficiency for certain conditions. Those distributors, we are talking about the mutual fund distributors, so those who are having multiple point presence more than 20 locations. Here it is mentioned 10 locations. No, it is wrong option. Those distributors who have point of presence in more than 20 locations are should have is a compulsory criteria for empanelment and review of those distributors. Then second, one, two, three, start. Business model, experience and proficiency in the business is a compulsory criteria for empanelment and review of which of the following category of mutual fund distributors? Option A. Individual distributors who have points of presence in more than 10 locations. Option B. Distributors who have received commission of over rupees 1 crore per annum across industry. Option C. Both the options are correct. So choose the right option. And the correct option is option B, distributors who have received commission of over rupees 1 crore per annum across industry. Now you must understand that SEBI has mandated the AMCs to regulate those distributors who satisfy any of the following criteria. Now those criteria are either the distributor is having multiple point presence in more than 20 locations. So first option is incorrect because it is mentioning 10 locations. If it has been distributors who have point of presence in more than 20 locations, it would have been correct. Then AUM raised over 100 crore across the industry in non-institutional category. Third, what SEBI mandated was commission received over rupees 1 crore per annum across industry. So you see, this is how option B is correct. Those distributors who have received commission of over rupees 1 crore across industry, due diligence has to be done for those particular distributors in terms of their business model, experience and proficiency. Okay. Now let's move to another question, which is question number 10. A mutual fund distributor cannot charge a transaction fee on which of these transactions? Option A, systematic transfer plan. Option B, a new investor making a purchase in a mutual fund scheme. Option C, an existing investor making a purchase in a mutual fund scheme. Option D, systematic investment plan. Choose the correct option. So the correct option is option A, systematic transfer plan. Reason, Transaction charges do not apply to transactions other than purchase, which result in fresh inflow of money. Okay, so if there are transactions like making a switch or transfer or dividend reinvestment, that won't be eligible for transactional charges. Transactional charges must involve purchase in a particular mutual fund scheme. So when we talk about SIP also, there is systematic investments going on a timely basis. Okay, so the purchase is happening. Question 11. Return from a fund is 9% and the risk-free rate is 5%. The standard deviation is 3 and beta is 1.6. What will be the numerator for calculating the Sharpe ratio? Option A 3, option B 6, option C 1.6 and option D 4. Choose the correct option. You may take time to calculate this and give me the answer. And the correct option is option D 4. Not much time was required for this calculation because it was only asking about the numerator for calculating Sharpe ratio. So if you remember the formula for Sharpe ratio, which I covered in my playlist videos, so Sharpe ratio is equal to return earned minus risk-free rate divided by standard deviation. Now what it is mentioning, return from a fund is 9%. What is the risk-free rate? It is 5%. And it will be divided by standard deviation, which is 3 if we have to calculate the Sharpe ratio. But this is asking only about the numerator. So what would be the numerator value? It will be return from fund minus risk-free rate, that is 9% minus 5%, which will be option D 4. Okay. Coming to question 12. The average net assets of a fund were rupees 800 crore and the investment transactions of fund were rupees 1600 crore. Calculate the portfolio turnover ratio. Option A 10 times, option B 0.5 times, option C 2 times and option D 20 times. And the correct option is option C 2 times. Now see, portfolio turnover ratio is calculated as value of purchase and sale of securities during a particular period divided by the average size of the net asset of scheme during that period. So here it has mentioned 1600 crore as the investment transaction in that particular fund and the average net asset was 800 crore. So what we will do, we will be dividing the investment transaction amount by the average net asset. So 1600 divided by 800 will be 2 times. That is the portfolio turnover ratio. Okay. Question 13. A mutual fund has the policy of imposing an exit load of 2% for redemption up to 1 year and 1% for redemption beyond 1 year. If an investor redeems 2000 units at an NAV of rupees 40 at the end of 6 months from the date of investment, what will be the redemption amount receivable by the investor? Option A rupees 76,500, option B rupees 79,200, option C rupees 80,000, option D rupees 78,400. So take your time, calculate this and choose the correct option. And the right answer is option D, rupees 78,400. I will explain this to you. So it says that there is an exit load of 2% for redemption up to 1 year. Now when this is person redeeming the money, it is at the end of 6 months. So obviously this is before 1 year and thus the exit load will be charged of 2%. Now another information. If an investor redeems 2000 units, so this is the total units that the investor is holding. What is the current NAV? It is rupees 40. So total units into the current price, that is 40 into 2000 is equal to 80,000, the total invested amount. So total invested amount is rupees 80,000. Now when this investor is redeeming the amount, because it is at the end of 6 months, which is before 1 year, 2% redemption will be charged. Now 80,000 was the total invested amount at current point of time. From that, we will be deducting 2% redemption charges, 2% of exit load. So what will be that? 2% of 80,000. Now that comes to 1600. So you will have to deduct 1600 from 80,000, and this will give you an answer of 78,400. Okay, again let me quickly make you understand this. So there was exit charge of 2% if an investor is redeeming the money before 1 year, and this investor is having total 2000 units and the current price or NAV is rupees 40. So what is the total investment amount at current point of time that the investor should get after redemption? It should be 2000 into 40, that is 80,000. Now because he is redeeming the money at the end of 6 months, which is before 1 year, 2% of exit load will be charged. So 2% of 80,000 is 1600. So we will deduct 1600 from 80,000. Now that gives us the redemption amount, which is 78,400. Now let's come to question 14. Indian mutual funds cannot invest in option A, real estate, option B, art, option C, securitized debt, option D, gold. Sorry, there's a mistake. It is written as B. It would be option D. Okay, so choose the correct option. And the right answer is option B, art. Indian mutual funds does not invest in the art. Question 15. Dash is or are non-financial transactions in a mutual fund. A, switch, B, pledge of units, C, nomination, or D, transmission. So option A, B and C, option B, B, C and D, option C, A, C and D, option D, C and D. So choose the correct option. And the correct option is option B, C and D. So when we are pledging the mutual fund units to take a loan, when we are nominating someone, we are providing nominee's name for the mutual funds, when there is a transmission, all these things are non-financial in nature. However, when we talk about switching is a financial transaction because you are making a switch from one particular scheme to another scheme. So there will be a purchase made in another scheme and there will be a redemption made in the previous scheme. So switching is a financial transaction. However, other three are not. So the correct option will be option B. Question 16. With respect to the procedure for getting impaneled as a mutual fund distributor with AMC, the applicant needs to sign a declaration for option A, guarantee of adding a minimum of 5 investors every month, option B, declaring the rebates given back to the investor, option C, ensuring that all employees who are selling mutual funds will have more than on ARN codes, option D, commitment to abide by statutory codes, guidelines and circulars. So choose the right option. So the right option is option D, commitment to abide by statutory codes, guidelines and circulars. Question 17. The expenses on dash cannot be charged to the mutual fund scheme. Option A, custodian fees, option B, depreciation, option C, trustee fees, option D, marketing expenses. Okay, so choose the correct option. And the correct option is option B, depreciation on fixed assets of the AMC. So the expenses on custodian fees, trustee fees or marketing expenses all are charged in the mutual fund scheme. However, depreciation is totally different concept and that is not included in any particular mutual fund scheme. Question 18. Which among the following bias can lead to a concentrated portfolio? Option A, familiarity bias. Option B, herd mentality. Option C, overconfidence bias. Option D, recency bias. And the correct option is option A, familiarity bias. Now, it is talking about the behavioral biases which are there in our finance, which tells how investors make mistakes on the basis of which of the following bias. So, here it is talking about concentrated portfolio. Now, what happens that any individual, they tend to prefer the familiar stock. Now, this sometimes proves to be favorable because when you are investing in stocks that you know about, which is good if you are totally confident on that stock. But many a time it happens that people are not sure about the values of that particular stock, the company in which that stock has invested the share of that particular company, but they have only a general idea. They are familiar with that particular stock. Now, this leads to an investor to miss out on many better opportunities. Okay, let me explain this with you a simple example that many people in because many people in our country, they are familiar with two of the banks which is most popular, one from public and one from private sector, the SBI bank and the SDFC bank. So what happens when these banks started making offerings in term of mutual fund schemes? So the general idea that people were having, they decided that they will go to SBI and they will buy any of the mutual fund scheme which is presented by the SBI or by the HDFC. Why? Because they were having a belief, they were familiar with these banks because of their large presence. They were having that confidence in the bank. So even if they don't know where the mutual fund schemes are investing, what is the portfolio, what is the strength, what was the past performance, regardless of all these things, they just get stuck in this familiarity bias because they were familiar with something, they chose that. And this lead to the concentrated portfolio because you are not exploring other options available in the market, you are not exploring other opportunities. Let's now come to question number 19. Where are the standard risk factors of a mutual fund scheme disclosed? So option A, fund fact sheet. Option B, addendum. Option C, statement of additional information. Option D, scheme information document. What do you think is the right option? And the correct option is option D, scheme information document. So this is talking about standard risk factors. Scheme information document or SID, they highlight two broad categories in terms of risk. First one is standard risk factor and second one is specific risk factors. So standard risk are that all mutual funds are exposed to, whereas specific risk applies to one particular mutual fund scheme. Okay, so that is where it is mentioned, it is disclosed in SIDs, scheme information document. Question 20. Calculate the tenor ratio from the following data. Return from a mutual fund scheme is 7.5%. The beta is 0.62. The risk-free rate of return is 6%. Option A 11.60. Option B 4.77. Option C 3.08. Option D 2.42. Choose the correct option. And the correct option is option D 2.42. So how this has been calculated? In my video about these ratios related to mutual funds, Sharpe ratio or Trenor ratio, I've explained these all numericals. So that's why I say that please go watch the chapter videos to get a better understanding. But for now, I'll explain in brief that how it is calculated. So Trenor ratio is return earned from a mutual fund scheme minus risk-free rate divided by beta. So here all three information is available. You see return from a mutual fund is 7.5%. The risk-free rate of return is 6% and the beta is 0.62. What does beta represent? It represents the risk related to in comparison with the market. So it is 0.62. What does risk-free rate of return represents? It represents that when you invest in a particular instrument which is considered to be risk-free like fixed deposits or government securities, that offers you a certain percent which is lower than other schemes or other investment options, and here it is given at 6%. So you usually compare that if I am taking risk, what is the return that I am getting for that particular extra risk that I am taking. Okay, so return. So what exactly is the formula for Trenor ratio? Is return from a mutual fund scheme minus risk-free rate divided by beta. Okay, so it will be 7.5 minus 6 divided by 0.62. Now this will give you the answer 2.42. Again I am repeating 7.5 minus 6% divided by 0.62. Coming to question 21, an investor purchases through a distributor 5,000 units of a mutual fund scheme at a NAV of rupees 25. The current NAV of the scheme is rupees 43. What will be the trail commission for today if the trail commission rate is 1% per annum? Your options are given. It is A rupees 2150, it is B rupees 33.18, it is C rupees 3.42, it is D rupees 5.89. So choose the correct option. And the correct option is option D, rupees 5.89. Now let me explain this how it has been calculated. So trail commission is always calculated at current NAV. So the first thing that you need to see is the current NAV of the scheme is rupees 43. So forget about what was the previous NAV at which the units were bought. Don't consider that. The current NAV is rupees 43. How many units are there? Units of mutual funds that has been purchased is 5,000. So what is the current value? 43 into 5,000, which will be equal to 2,15,000. Okay, so the current value of investment will be 43 into 5,000, that is 2,15,000. Now here it has mentioned the trail commission rate is 1% per annum. Do consider it is mentioning per annum and it is asking for today. So you need to give the answer for 1 day and it is mentioning the rate at per annum. So 1% of 2,15,000 and that you will divide by 365. So what answer you will be getting is 5.89. You must have made this calculation. 43 into 5,000 is the total current value of the investment. Now if we divide that with 1%, that will give our per annum trail commission rate, and if we will divide that with 365 days, we will get per day value. Okay. Do I need to repeat this? I'll repeat it once more because especially for the numerical question, it gets difficult if you don't know the concept and if you are not having the basic idea of the formula. So I'm again making you understand. I hope you'll go back to the chapter videos and you will try to figure it out. The current value of investment will be rupees 43 into 5,000, that is 2,15,000. What is the 1%? It is the trail commission rate per annum. So 1% of 2,15,000 will be the per annum trail commission, but we need to calculate for today. So 1% of 2,15,000 divided by 365 will give you this rupees 5.89. That is the trail commission for that particular day. Now let's come to question 22. Investors who have not transacted during the previous dash are known as dormant investors. Option A 15 months, option B 12 months, option C 9 months, option D 6 months. Choose the correct option. And the correct option is option D 6 months. Now dormant means not active. Non-active investors who are not making any transactions. So those kind of investors, if they are called as dormant investors, that means they have not made any transaction during the previous 6 months. Question 23. Which of these is not a function of registrar and transfer agents? Option A, maintaining investor record. Option B, processing redemption and dividend payouts. Option C, analyzing mutual fund performance. Option D, updating unit capital of the fund. And the right answer is option C, analyzing mutual fund performance. Rest all are the functions of RTA, that is registrar and transfer agents, when it comes to maintenance of investor record or processing redemption, dividend payouts or updating unit capital. All those are function, but analyzing mutual fund performance is not a function of RTA. Question 24. The NAV of an equity fund is 76.45 and the face value is rupees 10. An investor invests rupees 30,000. How many units will be allotted to him? Very simple question. Option A 1866.43. Option B 477. Option C 392.41. Option D 3000. What is the correct option? And the correct option is option C 392.41. How it is calculated? Now you know units are allotted as per the current NAV. So regardless of face value, we are not using face value. We have to use the NAV of the equity fund. So here the NAV is given as rupees 76.45. And how much is the amount invested by the investor? It is total 30,000. So 30,000 rupees divided by rupees 76.45, which is net asset value of one particular unit of that particular mutual fund scheme. So how many total units will be allotted to him? He will be allotted rupees 30,000 divided by rupees 76.45, that is 392.41 units. Okay. Question 25. AMFI Code of Ethics states that dash cannot become a distributor of mutual fund. Option A, banks. Option B, HNIs. Option C, employees of AMCs. Option D, impaneled distributors. And the correct option is option C, employees of AMC. As per AMFI Code of Ethics, they cannot become a distributor of mutual fund. Question 26. Identify the false statements. Statement A. When an investor wants to redeem from a scheme, the distributor must suggest redemption from the scheme with maximum exit load. Statement B. The mutual fund distributors can ignore the impact of exit load at the time of repurchase. Option A. Only statement A is false. Option B. Only statement B is false. Option C. Both statements A and B are false. So choose the correct option. And the correct option is option C. Both statements A and B are false. Okay. So distributor must suggest redemption with minimum exit load. Okay, here it is mentioning that maximum exit load, which is totally wrong. Distributors should always suggest that redemption should be with minimum exit load, and that's why most of the distributors, they tell you when you have to invest, they tell you that please hold on for a longer period of time, because if any exit load is applicable, you don't have to pay that, you can redeem after a certain period of time. For example, for many funds, there is an exit load if you redeem it before 3 years. For certain funds, it is for 1 year, depends on scheme to scheme. So distributor will always suggest you to redeem after the exit load period is over. Okay, so after 1 year, for a particular scheme, if the exit load was applicable before 1 year, so they will recommend you that hold it for a longer period of time, at least for that period of time where you don't have to pay any exit load charges. And then we see about this that mutual fund distributors can ignore the impact. No, this is totally not correct. We talked about minimizing the exit load, that what distributors should recommend. They can't totally ignore. They must let the investor know about the impact of the exit load, that how it will decrease the amount they are going to redeem if they redeem it before a certain period. So they must let the investor be aware about it. Thus, both statement A and B are false over here. Question 26 indicate which of these funds have lowest to highest risk sequence. A. Liquid fund, B. Credit risk fund, and C. Corporate bond fund. So option A is BCA, option B is CAB, option C is ABC, option D is ACB. Choose the correct option. And the correct option is option D, ACB. So here the question asks that the funds have to be arranged in a sequence lowest to highest risk. So obviously the liquid funds are least risky. Are least risky when it comes to the debt funds. They are the least risky ones as they invest in the high quality debt instrument. Then comes the corporate bond fund. Corporate bond funds, they are little more risky as compared to the liquid funds because they invest in corporate bonds. However, those corporate bonds in which this corporate bond fund invest are highly rated, are bonds with good rating. Okay, so whenever we are making investment in bond, we must consider the rating of bond because that gives us an idea about the risk involved in that particular bond. So corporate bond fund, they invest in those bonds which are rated AA plus or as such. However, when we talk about credit risk fund, this is comparatively riskier from corporate bond funds because they invest their money in those bonds which are AA or below that. So like not an excellently rated bonds, somewhere average rated bonds, they tend to choose that. So thus when we have to make this sequence of lowest to highest, we must go like liquid fund, then corporate bond fund, and then credit risk fund. Coming to question 28, identify the false statements. So statement A is for index funds, the NAV is calculated up to 4 decimal points. Statement B, the AMC and a mutual fund of the AMC can have the same auditor. Option A, only A is false. Option B, only B is false. Option C, both A and B are false. So you have to identify the false statements. Go with it. Choose the correct option. So only option B is false. Now we see that statement A says for index fund the NAV is calculated up to 4 decimal points, which is totally true. We know that NAV has to be calculated up to 4 decimal in cases of index fund or liquid fund or debt funds. When we come to statement B, the AMC and a mutual fund scheme of AMC can have the same auditor, which is wrong because it is we know that account of mutual fund schemes need to be maintained independent of the account of AMC. Now, if the accounts are being maintained independently, so does the auditor needs has to be different. So, auditor needs to be different for auditing of scheme and auditing of AMCs. Thus, they can't have the same auditor. Question 29. The cutoff timing guidelines are not applicable for option A, international funds, option B, new fund offer, option C, both of the above, option D, none of the above. Choose the correct option. And the correct option is option C, both of the above. So the cutoff timing guidelines are not applicable for international funds or for new fund offer. Question 30. Today's cost can be translated into future requirement of funds using the formula option A is equal to P divided 1 plus R raised to power N. Option B, A is equal to P into 1 plus R raised to power N. Option C, P is equal to A raised to power N into 1 plus R. Option D, sorry, this is by mistake, it will be option D. P is equal to A raised to power N into 1 plus R raised to power N. So you have to choose the correct formula that will be translating your present cost into future requirement or the future cost of fund. So choose the correct option. And the correct option is A is equal to P into 1 plus R raised to power N. So when you have to convert the present value of your investment into future requirement of fund or future value, we often use this formula where we calculate this amount by amount is equal to principal into 1 plus R is representing the rate of interest and here N is representing the time period. Question 31. Mutual funds today are benchmarked to the TRI and not to PRI. What is the advantage of TRI over PRI? Statement A, it ensures that the performance comparison is fair. Statement B, it increases transparency. Option A, only A. Option B, only B. Option C, both A and B. So it is asking about the advantage of TRI over PRI. You choose the correct option. And the correct option is both A and B, which means both A and B statement is true. Those are the advantages. Now, earlier mutual funds were benchmarked to PRI, which is price return variant of index. Now it is benchmarked to TRI, that is total return variant of index. Now price return variant of index used to capture only the capital gain from the mutual fund. However, when we talk about total return variant of index, it captures dividend, interest or any additions to the capital gain. So both A and B is correct as the total return variant of index ensures that the performance comparison is fair and it also increases the transparency. Question 32. Mr. A sees that his friends are investing in a finance scheme which is promising very high returns. He also blindly invests in the same scheme. Which bias is Mr. A exhibiting? Option A, herd mentality. Option B, loss aversion. Option C, confidence bias. Option D, anchoring. So here the correct option is option A, herd mentality. Okay, what does it say? That Mr. A is just observing his friend's investment pattern and he is doing the same thing. He is blindly investing in the same scheme. So he is dealing with this behavioral bias in finance which is referred as herd mentality. And this means that people tend to copy other investors. They tend to follow and copy other investors, which is totally wrong. You should analyze by your own and then decide which fund has you want to invest in, also after having a proper knowledge or taking advice from the advisors or persons who are having some kind of skill and experience in that particular field. Coming to question 33, in which of these fund is security transaction tax not charged? Option A, fixed maturity plans. Option B, equity index funds. Option C, equity linked savings scheme. Option D, blue chip equity funds. Choose the correct option. So the correct option is option A, fixed maturity plans. Now you must know that STT or securities transaction tax is not applicable to transactions in debt schemes. Now when we talk about other three options, equity index fund, equity ELSS or blue chip, all those are equity funds. So STT is applicable to equity funds, but it is not applicable to debt funds. So FMP, that is fixed maturity plan, is a close-ended debt fund and hence STT will not be charged over there. Question 34. An international fund is investing in US stocks. What would be the impact on it if US dollar depreciated against the Indian rupee? Option A, the NAV of the scheme in Indian rupees will depreciate. Option B, the NAV of the scheme in Indian rupees will appreciate. Option C, no impact on the fund as it's investing in stocks and not currency. And the correct option is the NAV of the scheme in Indian rupees will depreciate. Okay, so what is happening? An international fund is investing in US stocks. Now, when we are talking about an international funds, two kind of exposure is already there. Exposure on international equity market and exposure of the exchange rate. So here it is saying that what would be the impact on if US dollar depreciated against the Indian rupees. So because this fund was investing in an international fund and their particular currency is US dollar which depreciated, so obviously the NAV of the scheme will also depreciate. Why? Because this particular fund, this particular type of mutual fund, international fund, was investing in US market. Now, if the US market is not performing well, how will this fund perform well? Automatically, it will also depreciate. If the US dollar is depreciating, here also the NAV and the Indian rupees associated with depreciate. Okay. See, in case you have any doubt in these questions, you can always put it in comment. I usually reply to all my comments. I try my best to give you answers. So I'm trying to explain in a very short way because we are not having much time to explain each question that has already been covered in the chapter videos, but I'm trying to explain you in brief so that you can get a quick understanding. Even after this, if you feel you are having doubt with any question, do ask me in comments. I will reply you and I'll help you out with it. Question 35. When is the scheme information document updated? Option A, every year. Option B, every month. Option C, every 2 years. Option D, as per the AMC decision. And the correct option is option A, every year. Let's come to question 36. In case of exchange traded funds, ETFs, the minimum investment in securities of a particular index which is being replicated shall be -% of total assets. Option A 100, option B 95, option C 85, option D 75. Now the correct option is option B 95. So whenever we are talking about index funds, these are the open-ended scheme which track a specific index, which tend to replicate a particular index. When we talk about replication, that should be higher percent. So here the percent that is required for ETFs to track a particular index, to replicate a particular index, shall be 95%. Okay. Now let's come to question 37. The interim changes in a mutual fund scheme are updated to the investors through Option A, Key Information Memorandum, KIM. Option B, Statement of Additional Information, SAI. Option C, Addendum. Or option D, Scheme Information Document, SID. Choose the correct one. And the correct option is option C, Addendum. Question 38. Dash is the risk of mispricing or improper valuation of derivatives. Option A, counterparty risk. Option B, model risk. Option C, basis risk. Option D, credit risk. And the correct option is model risk. Model risk is the risk of mispricing or improper valuation. Question 39. The principle of caveat emptor applies to mutual fund investments. True or false? Option A, true. Option B, false. And the correct option is option A, true. So what does this principle caveat emptor applies? It in simple words, it means let the buyer be aware. So we know that mutual funds, they make it very obvious for their distributors or anyone who is involved in this mutual fund business to take it as a responsibility to make the investors aware about the mutual fund schemes. Okay, so that's why we see that always there is a declaration that these funds are subject to market risk, and they are making these things clear to the investors, and this scheme information documents is provided, KIM is provided, so that they get informations about the scheme in which they are making an investment, or in which they intend to make an investment. So here we can understand the principle of caveat emptor applies if there is any exit load, if there is any kind of charges and all that need to be open to the investor. They must know where their money is going, the portfolio, everything. So the principle totally applies to the mutual fund investment, and hence option A, true, is correct option. Question 40. The fund that takes contrary positions in different markets or securities such that the risk is neutralized and return is earned are called. Option A, thematic funds. Option B, dividend yield schemes. Option C, arbitrage funds. Option D, sector funds. And the correct option is option C, arbitrage funds. So arbitrage funds, they tend to take opposite position in different markets or different securities so that the risk can be neutralized. So you must have observed this example that someone has bought some shares in BSE and then they sold it in NSE at higher prices. So there were different exchanges. At one exchange they bought the share, at another exchange they sold the share. So they are trying to take a position, trying to gain advantage of this arbitrage. Okay, so that's what arbitrage funds deal with. Question 41. Which of the following types of analysis tracks the price and volume data related to trading in security? Option A, situation analysis. Option B, technical analysis. Option C, fundamental analysis. Option D, quantitative analysis. And the correct option is option B, technical analysis. Now, technical analysis studies price behavior of share to generate some future trends. So, when we are talking about the volume data, the price data related to trading, we should get this in mind. We are talking about the technical analysis. However, fundamental analysis, that studies the business and the model and tries to identify any potential in particular securities in future period of time. So that is mostly like a qualitative kind of thing when we talk about fundamental analysis. When we talk about technical analysis, it is more quantitative kind of thing. Okay, so here the correct option is option B, technical analysis. Question 42. The mutual fund application form is attached to the Option A, KIM. Option B, SAI. Option C, SID. Option D, AMC memorandum. Choose the correct option. And the correct option is option A, KIM. Question 43. Statement of account is to be sent to investors within dash days of NFO closure. Okay. You have to say how many days after the NFO is closed, the statement of account is sent to the investor. Option A, 3. Option B, 5 days. Option C, 10 days. Option D, 30 days. Okay. Choose the correct option. And the correct option is 5 days. So statement of account need to be sent to investor within 5 days of the NFO closure. NFO is new fund offer. Question 44. Which among the following is a measure of risk adjusted return of mutual fund scheme? Option A, standard deviation. Option B, beta. Option C, variance. Option D, Sharpe ratio. This is an easier one. You must know the answer. And the right answer is option D, Sharpe ratio. So we are talking about the measurement of risk adjusted return. Whenever we talk about return, all three other options is not valid. These options help in calculating the risk, but when we talk about the return factor, Sharpe ratio is the one which is used to measure the risk adjusted return of mutual fund scheme. Question 45. Tax deferral is a key feature of option A, dividend option. Option B, growth option. Option C, arbitrage fund. Option D, liquid schemes. Choose the correct option. And the correct option is growth option. Tax deferral is a key feature of growth option. Why is that? Because in growth option, the gains are accumulated. So investor need not pay tax every year. Only when he sells the units of mutual fund, the tax will be charged if it will be applicable. Otherwise there is no there is no fixed intervals in which the tax is to be paid by the investor. Thus, tax deferral is a prominent feature of growth option in mutual funds. Question 46. Consolidated account statement has to be dispatched to the investors. Option A, only when the investors send a request for it. Option B, on a monthly basis before 10th of succeeding month. Option C, for every transaction for every folio. Option D, quarterly for dormant investors. And the correct option is option B, on a monthly basis before 10th of the succeeding month. So consolidated account statement need to be sent by email on or before 10th of every month. And if there is no transaction happening, then a six monthly consolidated account statement can be sent. That is totally allowed in case of dormant investors. But if the transactions are happening on a monthly basis, cash has to be sent. Question 47. Dash is responsible for settlement of mutual fund transactions which are executed on the stock exchanges. Option A, AMC. Option B, stock exchange. Option C, clearinghouse. Option D, AMFI. Choose the correct option. And the correct option is AMC. AMC is the one who is responsible for settlement of mutual fund transactions which are executed on stock exchanges. Exchanges itself, they do not offer any kind of settlement guarantee. They are just routing system between the investors and the AMC. Question 48. Calculate NAV for the following information. Value of stock is rupees 200 crore. Value of money market instrument is rupees 25 crore. Dividend accrued but not received is rupees 10 crore. Amount receivable on sale of shares is rupees 5 crore. Amount payable on purchase of shares is rupees 10.5 crore, fees payable is rupees 1 crore, and number of outstanding shares is 3 crore. So you have to calculate the net asset value or NAV if these informations are provided to you. Okay, so option A is 75.83, option B is 80.77, option C is 76.16, option D is 79.17. So now take your time and try to calculate this and get back with the answer. And the correct option is option C, 76.16. Now how you have calculated? So NAV has to be calculated in a way like all the positive values you have to account, and then you have to deduct all the cash outflows. So cash inflow you try to add that, cash outflow you try to deduct it, and then divide by number of outstanding shares. So value of stock plus value of money market instrument plus dividend plus amount receivable. These are the total cash inflows, and now you have to deduct amount payable and fees payable out of that, and then divide it by number of outstanding shares, that is 3 crore. Okay, so let me tell you in this a numerical way. 200 plus 25 plus 10 plus 5. Okay, what all things I have added? 200 crore, that is value of stock, plus 25 crore, that is value of money market instrument, plus 10 crore, that is dividend accrued, and plus 5 crore, that is amount receivable. You add all these things and then you deduct minus 10.5 crore, that is amount payable, minus 1 crore, that is fees payable. Once you are done with this calculation, divide it by number of outstanding shares, that is 3 crore, and thus you will get the answer 76.16. That is the NAV. Okay. Let's get to question 49. A mutual fund scheme gives a return of 10% and the beta of that scheme is 0.5. The risk-free return is 7.5%. What is the tenure ratio of this scheme? So again you have to calculate the tenure ratio. Option A is 3%, option B 5%, option C 7.5%, option D 10%. Choose the correct option. And the correct option is option B, 5%. So how is tenure ratio calculated? Return earned from a particular scheme minus the risk-free rate divided by the beta. So in Sharpe ratio, what we were doing? The numerator was almost same, return earned minus risk-free rate, but we were dividing that by standard deviation. So that was a specific risk. When we are taking beta, we are also considering the market risk in the factor. So tenure ratio is considering the market risk. Now 10% minus 7.5% divided by 0.5 will give you your tenure ratio. Okay, so 10 minus 7.5 divided by 0.5 will be equal to 5%. Question 50. Higher the capital base, dash the risk appetite. Option A higher, option B lower, option C capital base has no effect on risk appetite, option D no change. And the correct option is option A higher. Higher will be the capital base, higher will be the risk appetite. In simple words, more money you are having lesser risk because you are having ample amount of money. You can take that risk in the investment. But if you are very stringent on your budget, if you are not having too much of money, then it becomes very risky for you to make an investment because you can't suffer the loss that will be involved and market is unpredictable. So higher the capital base, higher will be your ability to take the risk in the market. Question 51. What is the relationship between interest rates and real estate prices? Option A, rise in interest rates lead to fall in real estate prices. Option B, fall in interest rates lead to fall in real estate prices. Choose the correct one. So option A is correct. Rise in interest rates lead to fall in real estate prices, and here we are talking about the interest rates when you are going to borrow money. Okay, so most of the real estate demands are fulfilled by the consumers by borrowing loan from the bank or the financial companies. So what happens if the home loan rates are increased, if the housing loan rates are increased, then suddenly there will be lower demand for the real estate. Why? Because rise in the interest rate here will mean that the loans has become more expensive, and thus when people can't afford to buy real estate, they will be having less demand for it, and because of less demand there will be a fall in real estate prices. So everything is connected. When there will be rise in interest rate, it will suddenly lead to lower demand for real estate things, and thus the prices will fall. Question 52. Identify the false statement. Statement A. Authorized signatories have to sign the request for transactions of institutional investors in mutual funds. Statement B. Even if the MOA and AOA does not permit investment in mutual fund, the company can invest in mutual fund on the basis of board resolution. Option A, statement A is false. Option B, statement B is false. Option C, both statements A and B are false. And the right answer is option B. Only statement B is false. So statement A is totally correct because authorized signatories have to sign the request for transaction of institutional investors in mutual funds. See why statement B is incorrect? Because it is mentioning that even if it is not mentioned in MOA and AOA does not permit to invest in mutual funds, the company can do so. But which is totally wrong. We know that a company cannot invest in mutual fund if it's in corporation documents like memorandum of association and article of association do not provide for the same, because these documents MOA and AOA, as I mentioned, memorandum and article of association, the guidelines on what could be the areas in which a certain companies can function, what could be their duties, their roles, and their defined area. So they cannot go beyond that. So if it is not permitted in AOA and MOA, the company cannot invest in mutual funds. Okay, so statement B is false. Question 53. Identify the true statements. Statement A, unsystematic risk is measured by its beta. Statement B, the diversified stock index has a beta of 1. Statement C, an investment with a beta of 0.7 will move 7% when markets move by 10%. Option A and B are true. Option B, B and C are true. Option C, A and C are true. Option D, all A, B and C are true. Choose the correct option. And the correct option is option B. B and C are true statements. So statement A is false. Why it is? Unsystematic risk is measured by its beta, which is totally wrong because we know systematic risk is measured by beta. Systematic risk is also referred as market risk. Unsystematic risk is also referred as specific risk, which is related to a particular asset or scheme as such. Okay, so systematic risk is measured by beta, not unsystematic risk. Then statement B, diversified stock index has a beta of 1. We already covered this statement in one previous questions and we know why it has a beta of 1 and it is totally correct statement. Statements see that an investment with a beta of 0.7 will move 7% when markets move by 10%, which is again totally correct, because we know that market risk is having a beta value of 1. So 0.7 represents in terms of percent that 7% will be the movement when there will be a movement of 10% in the market. Okay. Question 54. In which of these cases will the lock-in in a retirement fund be lower than the prescribed 5 years? Option A, when the retirement age is earlier than 5 years from the date of investment. Option B, when the age of investor at the time of making initial investment is not less than 50 years. Option C, when the targeted corpus is achieved before 5 years. Option D, all of the above. Choose the correct option. And the correct option is when the retirement age is earlier than 5 years from the date of investment. So we know that these retirement funds, they come with a lock-in period of 5 years which cannot be compromised with. But in what cases these 5 years can be lower? So when the retirement age is earlier than 5 years, maybe a person invested in retirement fund and only 3 years was left to his retirement. So at 60 he was going to get retired, and at 57 he made the investment in this particular retirement fund. So once he will get retired, he will be able to redeem the fund. So the lock-in period there will be applicable only 3 years, not 5 years. So there can be such cases when the retirement age is earlier than 5 years, which is the prescribed lock-in period. Coming to question 55, an investor is interested in buying some units of a close-ended fund after the NFO is over, that is new fund offer. How can he buy the same? Option A, he can buy the units on the stock exchange from market makers appointed by mutual fund. He can buy the units on the stock exchange from other investors who are allotted the units and are interested in selling. Option C, he can buy the units from the mutual fund itself when they open the sale at periodic intervals as announced by the fund. Option D, he cannot buy units of a close-ended fund. Choose the correct option. And the correct option is option B. We know that the close-ended scheme, they offer liquidity to their investment through its listing on a stock exchange only. So once the NFO will be over, the investor can get and buy these units of stock, buy these units of fund from stock exchanges. Only if it will be available over there by other investors, they will be selling it, then the units can be purchased by another investor on the stock exchange. So liquidity is maintained through listing on a stock exchange in case of close-ended fund. Question 56. Whose job is to track the various corporate actions like bonus, dividend or right issues in companies where the mutual fund schemes has invested? Option A, custodian. Option B, registrar and transfer agency. Option C, unit holders. Option D, auditors. And the correct option is option A, custodian. Question 57. The investor cannot pledge the units of a mutual fund as a security to a financer. True or false? Option A, true. Option B, false. And the correct option is false. We know that there are loans which are provided against pledge of mutual fund units. Loan against pledge. So we can't, the statement is totally wrong. The investor can pledge the units of mutual fund as security to a financer, okay, to get the financing. Question 58. NAV of income funds is to be calculated up to dash decimals. I think this question is repeated one. So quickly you can answer. Option A 1, option B 2, option C 3, option D 4. And the correct option is option D 4. Question 59. Dash of the unit holders can pass a resolution to wind up a scheme. Option A 25%, option B 50%, option C 60%, option D, these sequencing is wrong. So you consider it like ABCD, 25, 50, 60 and 75%. And the correct option is 75%. So 75% of unit holders, they can together be able to terminate the appointment of AMC or winding up of a particular scheme. Question 60. Mutual funds can buy and sell securities only on delivery basis. State whether this statement is true or false. Option A true, option B false. Now this question is a repeated one from mock test part 1, where by mistake it was mentioned that this statement is false. However, the correct answer is true. Mutual funds can buy and sell securities only on delivery basis. There is no intraday trading that can be done in terms of mutual fund. Delivery basis means after the day is over, then you are getting the units of that particular fund. So it is done on delivery basis. It is not on intraday basis as in cases of stock shares listed on stock exchanges. So mutual funds can buy and sell securities only on delivery basis is a totally true statement. Okay. So thank you so much for watching this video. I hope my efforts will be a little helpful for you to clear your exam. Thank you so much.